It's Brian Preston, the money guy.
I can already hear you. A lot of you guys are like, man, I've got to have transportation.
Sure.
You know, because that's the other thing they get you is they're like, you got to have transportation, you know, so you might as well look cool doing it. But let's talk about actually what are the good ground rules to protect yourself so that you can insulate your mind. There's a reason Volkswagen a number of years ago had a commercial where they had a Volkswagen Bug that started very small on the gentleman's head.
Tiny bug.
And then they kept showing how it was getting bigger and bigger and bigger on, you know, as it was occupying more of his mind space. That is the reality of how cars are. You'll go smell the smell of a new car. You'll go test drive it, and you'll be like, "Oh man, I need to do this. This is what I need to do." So let's talk about how do you protect yourself.
So here is the first ground rule, and if you've listened to us for any amount of time, you know that we subscribe to the 23-8 rule. And this is what we say. And by the way, we've had a lot of questions on this. This is not just for new cars. This is for new or used cars. If you're
exactly
approaching an automobile purchase, you need to subscribe to 23-8. And what that means is you're going to put 20% down on the purchase of the car. You should not finance it for any more than 3 years or 36 months. And you have to make sure that whatever your payment for that automobile is, it does not exceed 8% of your gross monthly income. So figure out what you have coming in on a monthly basis, multiply that times 8%. Your car payment cannot be more than that. But there's an asterisk on our 23-8 rule.
Well, obviously, if you're buying a luxury brand, you want to pay for it almost like cash.
Yep.
I'm going to give you a little freedom on that, but it is pretty much same as cash because I don't want you getting out above your skis on what your wallet can afford. Mm-hmm. And here's the thing. I think some people who are new to the Money Guy show have had some confusion about 23-8. When we say 8% of your gross income, I had somebody ask me in YouTube comment section, they said, okay, if I make $100,000, you're saying the car can't exceed $8,000? I said, no. Your payments, total payments for the year cannot exceed $8,000.
That's right.
That's the big part of it. And look, we're giving you flexibility. I think this is what is unique about Financial Order of Operations. What's unique about the Money Guy show is that we try to actually give you financial guidance that you use in life that's more realistic because it's easy to be a pundit, especially somebody we're more mature in our financial journey, to look at everybody and say, you should only pay cash for all of your vehicles. That sounds great.
But it might not be practical.
But it's not what I did when I was 24 years old. It was not what I did when I was 32 years old. Yep. So we need to kind of make sure these ground rules actually reflect real life. So I have one other piece of guidance that will keep people, just like we have the 1 year on luxury cars, here's one more rule that will keep people from putting their financial life in the ditch.
Sure.
No matter what your car payment, if you are going to take us up on 23-8, meaning the flexibility of financing instead of paying 100% cash, here's one more piece of guidance you need to listen up for, and this is worth repeating. Your monthly investments should always exceed your car payment. I don't care if it's a used car. I don't care if it's a new car. If your car payments are much more than your investments, you're doing it absolutely wrong. That is a disaster. You need to have more money going into investments, which are building wealth, versus going into vehicles, which are depreciating and sucking wealth out of your financial life.
Yeah, so in practical terms, if you're not saving at least $200 a month to your army of dollar bills, you don't need a $200 car payment. If you're not saving at least $1,000 a month to your army of dollar bills, you don't need a $1,000 car payment. It's a really easy litmus test to make sure that you are keeping it inside the lines.
Well, it's gotten so easy to go. I mean, and look, this is not 23-8. I'm just telling you what dealerships will do. Even on something like a Tesla, you can get up to a 6 or 7 year loan these days.
Yep.
So it's easy to turn a very expensive car to where you might have $800 a month payments. And you're like, well, you know, I can afford $800. But if you're not saving $800 to $1,000, you know, you're doing it completely wrong. Because what I don't want to see is somebody go somehow justify in their head it's okay to spend $800 a month on a car payment while they're saving $150 into their investments. That's a complete disaster. You'll wake up when you're my age and go, why don't I have more money? You know, and that's why I want you to not fake it until you make it. We actually want you to build wealth.
Now, one of the things I love about doing the show the way we do is we have this live stream going on, and you guys ask us questions in here, and we'll save some for the end, but 2 questions just came in that I thought were great. One question was, hey guys, when you're talking about this 8%, 23 8%, is it your gross income or your net income, your take home? we recognize that when you're just starting out, it might be a hard road to toe to kind of make all the numbers fit and be able to do everything. So we give you some wiggle room, and we say it's based off of your gross income. Now, if you want to be really, really conservative, then okay, use your net income, but our rule of thumb, 23.8, is 8% off of gross income. Now, here's the other question that came in. All right, guys, I hear that. You talk about my monthly payment. Does that include maintenance or does that exclude maintenance? Again, the answer to the question is it depends on how conservative you want to be. When we talk about the monthly payment, we're really talking about the principal and interest on the auto loan, excluding maintenance. But if you can get all of the costs, insurance and everything else to be inside that 8%, it's gravy. You just have that much more affordable of a car.
Yeah, it really depends upon how far into your financial journey you are. I mean, because you'll look. When I was first starting out, I know we're doing a show on vehicles, but think about houses. I don't know why I went through all of everything but housing just then through my brain. But when you think about housing, we have a rule for that too. It's 25% of your gross income.
Yep.
Look, when I'm younger, I'm hitting that thing as much as I can, and it's just principal, interest, and taxes and insurance, and that's it.
Yep.
But as you get older and you're more secure, and you're trying to make sure you're not, boosting your lifestyle to a point that it's impacting your financial life, that 25% might have expanded beyond principal, interest, insurance, and taxes to also include utilities. So, I mean, it's the same thing with your cars. I just don't want you jumping into the luxury train of buying nice cars before your financial life actually reflects you being warranted to do that.
Now, since you said a house, I think it's important to kind of make a note here because a lot of folks say, oh, well, if I buy a really good car, it's not really, I'm not buying it, it's an investment.
It's an asset.
Hear us loud and clear here. Automobiles are not investment assets, they're use assets. And so whenever we use that kind of terminology, we got to do sort of a Webster's dictionary definition. Investment assets, generally speaking, are expected to increase in value over time. I buy something for $100 today, I'd like for it to be worth $200 tomorrow. Use assets,
especially cars,
very generally, not all the time, but in most circumstances, decrease in value over time. I expect to pay $100 for it. I'm going to use it, and then later on, I'm going to sell it for something less than I paid for it. Now, that doesn't always hold true, but it's a good rule of thumb to keep in mind. When you're doing your annual net worth statement, you're putting all the things on there you bought throughout the course of the year, you should ask yourself, was this an investment or was this a use asset?
That's a great way of putting it. I would, the only thing I want to talk about, add to it as well, is because I think a lot of people are going to absorb a lot of this, and they're going to say, wow, that's a lot to think of, the 23.8, the investments over, the car payments. There's another decision that everybody faces, and they're trying to figure out when is the right time, new versus used.
Yep.
I mean, I think this is a big decision point that a lot of people struggle with is because you're trying to figure out where do I fall on that. The first thing you need to understand is let's talk about depreciation of new cars.
Yeah, so we had FTE Daniel put together some data from Edmunds, and I thought this was pretty remarkable. This actually shows in the first 10 years of an automobile how much the value of that automobile on average depreciates through time. And this is for a new car. So you see, generally speaking, on average, year one, it holds about 81% of its value. Year two, 69% of its value. Year three, 58, 49, 40, 33, and so on. Every year, because it's a use asset, it becomes less and less valuable.
Yeah, I mean, what I think is interesting is like that first year, it loses 19%. Here's what will blow your mind. That 19% is not an equal amount every month.
Right.
It actually loses 10% in the first month that you own it. So think about that. I mean, that's a pretty big deal that half of that first year depreciation actually occurs in the first few weeks you drive it off the lot. It literally, as you drive it off the new car lot, just basically dropped 10% of its value.
Now, as we were talking in show prep, and I thought this was beautiful, we arrived at the conclusion that all new cars depreciate, right? It's going to happen. It's just a function of who's going to pay the depreciation.
Yeah.
Are you, the consumer, going to be the one that pays that first couple years of depreciation, or are you going to try to pick up that car that might be 3, 4, 5 years old? And so that's why I always said, if you're thinking about buying a used car and you're kind of basing this off of the depreciation scale, The sort of ideal time to buy a used car is sometime between year 4 and what's that? 7, 4, and
Yeah, I mean, somewhere
range?
between. I'm willing to give a little more. Once again, I love adding flexibility because I think about my own life and how I did things because I never want us to be somebody who gives one piece of advice, but then we did something completely different. I think if you are somebody who can think of terms of somewhere between years 3 through 6, your decision there is: do I want a 40% off coupon or do I want a 60% off coupon? And that's really the choice that you have there. Still, a 40% off is pretty good for because a 3-year-old car. What's interesting, my wife's car is 3 years old. I was thinking about that this morning as we were doing. I still feel like it's a brand new car. I mean, because it's 3 years old. It has like right at 30,000 miles. That car is brand new. The people who go and trade in a car every year, I don't get it because this still feels like a brand new car after it's 3 years old. So ask yourself, 3, which is a 40% discount, 6, which is going to be close to a 60% discount. The choice is yours. It's much better than buying a new car. And here's the other thing to give you perspective. I didn't buy my first new car because I think we know our biggest group of listeners are people in that 25 years old to 34 years of age. That is our biggest segment that's out there on YouTube.
Sure.
I didn't buy my first new car until I was 32 years old.
So every car purchase, and there were a number of them that you made prior to 32 were all used cars. You didn't go to the lot and buy one off the lot brand new. And I think there's nothing wrong with that. I think a lot of folks, because you just said you can get a better deal. I imagine the maintenance costs on used cars tend to be a little bit low when you think about insurance and that sort of thing. There's nothing wrong with buying used cars.
Right. And I think that's something because people out there in YouTube world and in comment sections, I see 20-somethings that know I love Tesla, and they're trying to figure out how they can buy a Tesla.
Sure.
And that concerns me a little bit because I want to make sure you get the financial order of operations right, that you're not putting how cool you'll look ahead of where your financial life is going and making sure you're building the right foundation. So I want to kind of pivot to, when does a new car make sense?
Now, this is something that I'm excited about, Brian, because I feel like in the personal finance space, for years and years and years, the only answer was, if you're going to be a responsible financial decision maker, you have to buy a used car.
Yep.
I would say that our advice is not necessarily that hard and fast. We think there actually are times when a new car could make sense. Fair statement on my part?
Fair statement, but let's put some ideas and thoughts out here. First of all, we have like one of our dear employees, Carol.
Yep.
Her and her husband, super successful financially.
Yep.
I think they are under the camp. If you had a meter of where you are on used versus new, they're solidly pretty much not all the way over, but they pretty much only buy used cars. And I think that makes them great. Now, there's another group, because I know you have bought new cars.
Yep.
I know I've bought new cars. Does that mean that we're horrible with money? No. Here's the key determining factor. The vehicle purchase doesn't impact or decide whether or not you're financially successful.
I think that's such a great point. So the decision to buy a new car is not because there was some concession of, oh, you know what, I really want that new car. I'm just going to decrease my 401k contribution. I'm just not going to max out my Roth. It's not that. It's that they're at a place and a stage in life where they can afford to pay a premium for something that they place value on.
Yeah. Now, is it a good financial decision? Of course not.
Sure.
But you have enough margin. Remember, you're already doing all the other things in financial order of operations where you're saving 20 to 25% for retirement. You're doing all the things like thinking about prepaid expenses with the kiddos in college and so forth. And you still have enough margin in your life that, you know what, you're willing, it's a sucker's bet, but you're willing to let some of those dollars go into an asset that's going to depreciate. Now, here's the way I justify this in my brain. I know I'm driving this car for 8 to 10 years.
Yeah.
So, yeah, it's a sucker's bet, but I like the fact that I know where that car came from. I like the convenience. I don't have to worry about it getting me where I'm going. And don't forget, I didn't do this until I was over 32 years of age. I had built up a lot of armies already doing the right things. That margin, yes, I can maximize more dollars, but it's not blowing up the financial plan.